Do they have a pile of money equal to everyone's covered amount? Absolutely not. But your insurance company does not have a pile of money equal to everyone at State Farm totaling their car this week either.
The Federal Deposit Insurance Corporation, FDIC, has issued a stark warning. 63 banks are teetering on the edge of insolvency, with potential losses amounting to a staggering $517 billion. This dire situation has sent shockwaves through the financial sector, leading many depositors and businesses to question the stability of the banking system. The FDIC, responsible for maintaining confidence in the nation's financial system, has sounded the alarm, urging depositors to reassess the security of their funds. The FDIC's warning comes amid growing concerns over paper losses on certain securities held by U.S. banks. A report from Bloomberg highlights that these losses are not limited to securities, but extend to banks' loan portfolios, exacerbating their financial troubles. A significant factor contributing to these losses is the deteriorating condition of the housing market. While commercial real estate has garnered much attention, the FDIC's focus on housing market stresses is particularly noteworthy. Once considered robust, the housing market is now showing signs of severe strain. In the first 3 months of 2024 alone, unrealized losses across the sector have reached $517 billion. This marks the 9th consecutive quarter of escalating losses, indicating a prolonged and troubling trend. The impact of these losses on banks' financial health is profound, leading to an increase in non-performing loans and a significant decline in capital reserves. Despite these mounting challenges, the FDIC maintains that the banking industry remains solid. This assertion, however, seems contradictory given the escalating financial difficulties faced by banks. It raises questions about the true state of the banking system and the efficacy of current regulatory oversight. Particularly concerning is the rising number of homes with mortgages that exceed the property's value by at least 25%. This situation has worsened with increasing mortgage rates, reducing housing demand, and further destabilizing the market. The broader economic implications are significant. Banks have tightened lending standards, restricting access to credit for consumers and businesses alike. This credit crunch could stifle economic growth, exacerbating the financial system's strain. The FDIC's role, traditionally seen as a safety net for depositors, is now under scrutiny as the agency's capacity to fully protect deposits comes into question. The FDIC's warning is rooted in recent developments within the banking sector. According to the FDIC, U.S. banks have been facing increasing paper losses on certain securities, underscoring the severity of the situation. These losses, coupled with challenges in their loan portfolios, have created a complex and worrisome scenario for the banking industry. The deteriorating housing market is a primary driver of these financial woes. Unrealized losses in the housing sector have mounted for 9 consecutive quarters, highlighting the prolonged nature of the issue. This sustained decline has led to a significant number of non-performing loans, weakening banks' capital reserves and increasing their vulnerability to insolvency. The possibility of bank failures looms large. While the FDIC provides insurance coverage up to $250,000 per account, the scale of the current crisis raises doubts about the agency's ability to fully protect depositors. The FDIC's Deposit Insurance Fund, DIF, is under immense pressure with a balance of approximately $128.2 billion as of December 31st, 2023. This may seem substantial, but it pales in comparison to the trillions of dollars in deposits held by U.S. banks. Multiple bank failures could quickly deplete the fund's resources. Given the FDIC's strained resources, the concept of bail-ins has gained traction. A bail-in involves converting a bank's debt into equity, effectively making creditors and depositors bear the losses. While this approach could stabilize individual banks, it also means that depositors could lose a significant portion of their funds, even those within the FDIC's insurance limits. In light of the uncertainties surrounding the banking sector, it is crucial for individuals and businesses to diversify their financial holdings. Spreading funds across multiple banks and exploring alternative investments can mitigate the risk of losses in the event of bank failures. However, it is essential to approach diversification strategically and seek guidance from financial professionals to ensure a balanced portfolio. The FDIC's warning highlights the urgent need for systemic reforms in the banking sector. Short-term measures such as increasing the FDIC's insurance limits or providing additional funding to the DIF may offer temporary relief but do not address the underlying structural issues. Strengthening bank capital requirements is one critical area of focus. By requiring banks to hold more capital relative to their assets, regulators can create a buffer to absorb losses during economic stress, reducing the likelihood of bank failures and mitigating risks to depositors. Improving transparency and oversight in the banking sector is equally important. Regulators need the tools and authority to effectively monitor banks' activities and identify risks before they escalate into a full-blown crisis. This might involve implementing more rigorous reporting requirements, conducting regular stress tests, and enforcing penalties for non-compliance. Given the significant impact of the housing market on the banking sector, addressing challenges in this area is crucial. Policymakers should work to stabilize the housing market, potentially through mortgage relief programs, incentives for affordable housing development, and reforms in the mortgage lending process. The ongoing issues in the housing market highlight the interconnectedness of economic sectors and the need for comprehensive solutions. The FDIC's warning serves as a reminder that the banking system is vulnerable to external shocks, and depositors must remain vigilant. Monitoring economic indicators, diversifying assets, and seeking expert advice are critical steps to protect financial interests. While the FDIC's warning is cause for concern, it does not necessarily signal imminent disaster. By staying informed and making prudent financial decisions, individuals and businesses can navigate these uncertain times more effectively. The recent FDIC warning underscores the vulnerability of the financial system and the need for decisive action from policymakers. The combination of losses in the housing market and the banking sector has created a precarious situation that demands immediate attention. While the FDIC's deposit insurance offers some protection, it is not a foolproof guarantee in the face of widespread bank failures. It is incumbent upon policymakers to address the underlying issues in the banking sector and restore confidence in the system. A coordinated effort is essential to navigate this challenging period and emerge with a more robust and stable financial system. Strengthening bank capital requirements, enhancing transparency and oversight, and stabilizing the housing market are critical steps in this process. The road ahead may be tough, but by heeding the FDIC's warning and taking appropriate measures, we can mitigate risks and safeguard the savings of millions of Americans. The FDIC's warning about the potential insolvency of 63 banks has highlighted significant vulnerabilities in the U.S. banking system. The combination of paper losses on securities, challenges in loan portfolios, and the deteriorating housing market has created a complex and concerning scenario. The possibility of bank failures, coupled with the FDIC's strained resources, underscores the importance of diversification and proactive financial management. Systemic reforms are necessary to address the root causes of these issues and restore confidence in the banking sector. By strengthening capital requirements, improving transparency, and stabilizing the housing market, policymakers can create a more resilient financial system. The FDIC's warning serves as a wake-up call, emphasizing the need for vigilance and proactive measures to protect depositors' hard-earned savings. If you found this video informative and want to stay updated on the latest financial news, please subscribe to our channel, like this video, and leave a comment below. Together, we can navigate these uncertain times and ensure a more secure financial future.